Pat Bustamante, there is a huge fall in inflation for the month of August. What were the main drivers?
And you're correct. It was widely expected. The 2.7 was our forecast, and it was also consistent with the market forecast. So the main driver, I haven't really had a chance to look through all the numbers, but it would be the electricity rebates from the federal government, which are flowing through into bills in the month of August. So these rebates are essentially designed to reduce their out-of-pocket expenses on a temporary basis when it comes to electricity. So we know that's going to, flow. We know that's flown through. But what the RBA was really getting at yesterday is that they want to see inflation come down in a sustainable manner, not temporarily. And we know these rebates only last for the 24-25 financial year. And once they're lifted, you could see inflation jump back up. So the RBA is looking more closely at the underlying, as you said, the core measure. And that strips away large movements in prices on a quarter-by-quarter basis. So that will give you an underlying sense of inflationary pressures across the economy. And we get that at the end of October.
And I mean, as I was just talking to Kath about, it's probably curious for many that the headline rate falls to within the target band, but the RBA is not planning on budging on rates. You pointed to the fact around those temporary measures. Is that essentially the reason it's going to overlook this fall?
That's right. So it's a temporary, measure. It's going to last for, 1 year, unless it's extended. But what they're really concerned about is not necessarily what's happening on the goods side or electricity prices, but what's happening on services and services inflation, which relates more to domestic cost pressures. And that's where the Reserve Bank really wants to see, this inflation pick up at a quicker pace than what we've seen over the last, 6 to 12 months. So that's what the Reserve Bank's really concerned about, not necessarily electricity prices, which really drove that decline we saw today.
And when we look at the trimmed mean from the ABS, it says when it excludes falls in automotive fuel and electricity along other large and big price rises and falls, it was actually 3.4% down from 3.8%. So that is outside of the target band.
That's right. So that's kind of one measure. But you're right in saying that those monthly numbers don't, pick up the full CPI basket. It's only a partial read. They tend to be quite volatile. So the RBA signalled quite clearly yesterday that they're waiting to see for the quarterly update, which we get at the end of October.
And I mean, that quarterly number, why is it more comprehensive than these monthly numbers that we get?
It's just at the moment, the ABS only updates the basket, on a monthly basis and on a partial basis every month. They're working towards, more of a comprehensive monthly update going forward. I think it starts next year at some point. But at this stage, it's the ABS that measures, a partial part of the basket on a monthly basis, which is more of a process thing as opposed to anything else.
Yeah. So your view is that the first rate cut that we'll see will be in February. Is there anything that could change that?
Yeah, so that's our view at the moment. And we think by the time February rolls around, we'll have more inflation data, which includes the December quarter outcome. And we think by that point in time, the Reserve Bank will be confident that the inflation rate is coming down on a sustainable manner back to target. You could get surprises on either side. So we saw the national accounts point to quite a lot of weakness in domestic sectors of the economy, particularly the household sector. So we saw consumption actually fall in the June quarter. So if some of the downside risks to the labour market materialise, we could see potentially a shift or quicker, a more aggressive cutting cycle from the Reserve Bank. But on the flip side, you could see inflation become more sticky. We could see potentially more elevated inflation once we get that quarter three outcome in the end of October. So that could leave the Reserve Bank on the sidelines for longer. It really depends on the balance of risk, and we'll get clearer steer as we get more data towards the end of the year. But at this point in time, our view is that by the time the February meeting rolls around, the Reserve Bank Board will have enough meeting to be confident that inflation's heading in the right direction, and we'll be within a reasonable time frame on a sustainable manner, so not temporarily, which is the key at this point.
So still a waiting game for those with large debts like mortgages. Pat Bustamante, thank you so much for your time.
Thanks a lot. Pleasure being here.